Right then, absorption. This is one of the key things that you're going to see. Remember, as I talked about in the intro, it's all about looking at the difference between absorption and momentum. Is a market being slowed down by passive orders preventing a continuation of movement, which is what absorption is, or is it the ability of aggressing orders to maintain the pace of movement, to drive through anybody who stands in their way? We're going to look now at different ways that you can interpret and trade absorption. How do you go about it? Where do you execute trades? What needs to happen in order for you to want to buy into an absorption or to join the absorption? So let's get started. What's the point of absorption? You'll hear it referred to as various different things. It will be referred to as iceberging or reloading. And the simple idea of it, and the simple reason that people use this method of execution, is to not show what they want to sell. What they do is they present, let's call it an offer, of a small or an average size number of contracts, the same as most of the other orders around. But each time that order gets traded, whoever is putting the order there will add the order back. So let's say it's 100 lots, every time 100 trades, the person who gets that 100 puts another 100 there. This way, they never show how much they want to sell because that could scare the market essentially. If you have 5,000 to sell and you put 5,000 on the offer, people will very quickly recognize that and think, we should probably not try and buy into it, for one, which means you won't be able to get your business done. And two, people will start to sell, so move the price away from you. If you show that, you're going to get stuck not being able to get your order filled and essentially then having to chase price. So the idea is to minimize the price fluctuation in you getting a large order done. So that's the simple reason for why people do this. Where this creates a trade opportunity, an area of uncertainty, is that you don't know how much their order size is. Someone keeps putting hundreds on. Do you know that they've got another 3 of them to do, or have they got another 30 of them to do? You don't know. And that's the bit that requires an understanding of how the market is trading relative to that order, which is then going to dictate to you how you want to trade around it, what you want to do next. So, what's the impact of somebody reloading or iceberging, however you want to term it? Well, quite simply, it creates a barrier. It slows the market down. If you want to move up and someone starts to iceberg the offer, continually builds the offer up, well, you're going to need a lot more buyers to be able to keep the move going. So that's the first thing that it does. It slows down direction, at least in the short term. What you now need to try and work out then we'll start from what you now need to work out. What you now need to work out then is whether the iceberg has been completed or not. Has it been completely filled, or is the trade into the iceberg running out before the iceberg is complete? So imagine this, you have a particularly large order here, somebody keeps on putting their order in. As the market trades into it, either people will trade sufficient number into this order and the market will then keep on going, or you will run out of buyers, in which case now the person with the large order may have to start trying to sell and actively selling lower prices. People who have bought into the large order expecting a break equally may now be trapped and start to try and get out for a small loss before it becomes a large loss. That's the two ways that it can break or hold. The other thing that it's going to do is it's going to create a volume ledge. It's going to create an artificial high or low, or at least an artificial stall point within the market. If it holds, well, this still creates a reference for the coming days. And this is why it's really valuable from a footprint to see this. A footprint will highlight this for you quite well, but also very valuable to just make a note of these. Because 2 days later, when you come back to it, if you're aware that that's what happened when we were last there, straight away, you know exactly what you're looking for. You're looking for that iceberg. And if it's not there, the market can move. Say you have a market that drops and bounces, large iceberg on the low, you get back down there. If they're not there this time, you can have a lot of confidence to sell it straight through the low, because the only reason that the market bounced here is the iceberg. If the iceberg is no longer there, what's the reason to bounce? And for that reason, you can then sell it through the level. But if you don't see that order flow, if all you've got is a candlestick that shows that's the low, chances are you're going to look at that and think, well, that's a good level, we'll buy this. It's about seeing that order flow there. So let's go and have a little look at 3 different reactions that you can get to an iceberg. First up, nice, simple hold. And you've got to think through the mechanics of what exactly is happening here. What will happen? Using the example of a sell-off, so in each of these we'll see a sell, market comes off, and you then get an iceberg at the low, or the iceberg creates the low, in fact, in this instance. So what will happen then is this slows down the pace, because sellers now don't get any continuation movement when they sell. All they do is they hit into this large order. So as they do so, what's going to happen is they'll recognize the market is not continuing down, and people will start to profit take, causing a small bounce. Not everybody's going to do this immediately, and the little bounce is also going to be an opportunity to have another go at selling. But once again, sellers run into another large order. So you've now got a lot of, or an increasing number of people selling it right down at the low and going nowhere. You know, imagine that feeling. You sell it, and all that happens is you sell, and the market ticks back against you. You never get on side. This creates an element of doubt for traders, and they will sit there thinking, I don't really want to hold on to my shorts if this bounces, and people will then start to take profit. But really, what's going to happen is this selling essentially gets exhausted. You run out of sellers, and that's fine. But the point where the reversal comes from then is once you get out of this small range, because clearly to go back down, you still need sellers. And so what you're looking for then is first up, the absorption to come in. Somebody keeps on putting their bid back, put their bid back, put their bid back, put their bid back. And after that then, once it sort of rotates in a small range, and I'll give you an example of this in a moment. Once you get away from this range, then you get the acceleration. Because at this point, anybody who was selling feels that they're wrong now. So then you end up with a situation with very few sellers because everyone's already sold. And so a market will then trade up nice and quick, and you get that momentum, lifts the offer, bid, lifts the offer, bid, lifts the offer, bid. That's what you're going to expect to see here. So it's about understanding where you're going to see those different bits of order flow. Next up, you can get a break. What happens with a break is that the iceberg, unlike over here, does not exhaust that selling pace. So what you'll get is the same kind of pace coming down here as you do here. And you'll get that quick little reactive bounce as people recognize an iceberg and think, right, take a bit of profit. But once the second move starts to come down, the pace comes at the same pace that came in here. It is still flowing through. There's still hit the bid, hit the bid, hit the bid, hit the bid. Whereas here, you get less and less and less of it. More what happens here is it becomes two directional. People hit into the bid, and then people will lift the offer. Hit the bid, lift the offer. Whereas here, you don't get that. When it's going to break, you still see this very fast. Hit the bid, hit the bid, hit the bid. And so therefore, it doesn't bounce away from here. Instead, people just keep on hit, 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 hit. The iceberg gets overwhelmed, and the market then continues that pace towards the downside. The other thing is, typically below the iceberg, you won't get a great deal of liquidity. For an obvious reason. If you can see that somebody is buying a lot and continues to add to their position down at this low, you're not going to put your bid behind them because you're not going to get filled. And the only way that you're going to get filled is once there's enough sellers to get rid of this order. Now, if you can find enough sellers to get through a large buy order at a low, this means you'll find a significant number of sellers at the lows. You don't want to buy just below there because they're going to run you over very quickly. Because the people who don't manage to sell into that large order now start to chase down, meaning that anybody with a bid below is going to get washed out very, very quickly. So you get this low liquidity below a large order, or behind the large order, the iceberg that you're seeing. It's more obvious even when it is a large order, and we'll touch on those in another section. The other version is that you get the return of the iceberg, and this can be quick. There's no time scale on this, but moves like this, and I'll give you an illustration of one like this, can happen in a matter of seconds, 10 seconds, 30 seconds, break straight back. Now what happens here then is you get the same pattern. Market drops, iceberg, bounce reaction to the iceberg. And that's just simply people start to realize that it may not be going any further, and people then start to lift the offers in order to profit take. You then get a second move down. And what's going to happen at the break point is very similar to this. You're expecting this cascade of selling. People need to sell, and so they're going to rush in to sell as that iceberg breaks. But where you don't get continuation is where it's a situation that the only people selling are the people who have been buying above the large order or above the iceberg and then get stopped out. So they get forced out. But if you don't then see continued selling, so you don't get that continued pace of selling like you do on the break, but instead it's fast, stall, back up, that's the point where you can get the reversal. And what will then happen is you may well in fact get the iceberg come back at the same price. Whether it comes back or not, typically the price where the iceberg was over here acts as support again. Anybody who sold on the break is clearly wrong, and so they get forced out. And anybody who was buying and got stopped out is now getting the chance to buy the same price again. This is now their opportunity to play the move up with now a clear stop. So this is then looking at a kind of false break, but seeing the actual order flow behind it. And we'll go and look at each of these different types of breaks in turn. To start with, we're going to look at hold, how a market gets held, how you start to see the absorption run the buyers out or run the sellers out. And as the aggressing orders, the ones that trade into that absorption, fail to keep the move going, this is where the turnover starts to come from. So let's go and have a little look at what I call iceberg partnering. This is joining an iceberg. You can see what they're trying to do. You can see that they're slowing down the market. You join them. The great advantage of doing this is that because the iceberg gets traded into and then refills, you can get yourself to the front of the queue with a larger order behind you. Let's say somebody's putting a 100 lot bid, market trades into them, that order goes down, you get behind the 100 initially. As they get filled, you get close to the front of the queue. Now, as they get filled, they then increase their order, but that order goes behind you, meaning you're now at the front of the queue with a larger order behind you. You've now got protection. So that's one great aspect of it, meaning that most likely if you're doing this joining an iceberging bid, chances are you won't even see the market go offered against you. So you join the iceberg. What you do with the trade is up to you. You can either do it to join the iceberg and just scalp small winners each time it bounces, take 2 free ticks out of it. Or if you've got a level, you've got a reason to want to play this as a more directional trade, you use that opportunity to play into the iceberg, you hold it through this bit, and once you break away from here, you've now got yourself a very strong entry position at the low with a very, very clear stop. The iceberg breaks, you're out. You don't need a number of ticks, you don't need anything else. Quite simply, if the iceberg disappears, your reason for being in the trade is no longer there, you can get out. Generally for a reasonably small 1-2 tick loss. Your stop needs to be just behind the iceberg. Remember, if there's low liquidity behind the iceberg, you don't want to stop down here because the market's going to zip to it anyway. You might as well have a stop 1 tick behind it so that if it is going to go through, at least you take the minimal loss. So that's the idea, you're going to join it. You can have conviction joining it if you've got a reference, a reason to want to be in at that point anyway. But the key thing that you want to see here is you want to see the counter aggression slowing down. If people keep on hitting that iceberg as fast as they were when you first saw it, this is where the trade is less likely to work. You want to see this slow down. You want to see people sell into it less and less and less. That way, it allows other buyers to realize that maybe they're not going to get filled. And they're then going to start to hit into the offer. And that's what then creates this push back towards the upside. That's what you're after when you're looking at a trade like this. It's much easier to spot these trades when the market is faster. Sounds counterintuitive, but when it's quicker, you identify that stall. It's much more obvious when a market slows down from a fast pace to going from a slow pace to a slightly slower pace. It's much, much harder to recognize. So let's go and have a little look at an example of this. Okay, so here's a simple example. No chart on here, so the reason for buying here is unclear. As such, this is then going to be a more scalp type trade. So what we're going to look for then is identification of the absorption. I've got a rough explanation of it down here, but I'm going to focus on the ladder here for you. What we've been in then, we've been in a short position for around the mid-60s. Market's now dropping down. So what you're looking for now, and well, initially you're not looking for any kind of absorption, you're just watching what's going on. But there was a little bit of a stall down here at 45, 46, and that's the reason for getting out of position. And this is a slower move. I want to purposely show you slower moves and quicker moves so that you get to see what these things look like. So it's easy to see them on fast moves. You want to be looking at the slower ones as well. So what we've just seen is a bit of trade into 46. And so the main prices that you're going to see this trade across, 47, 46, and 45. So you watch down there and watch this last traded quantity. Each time we trade 46, the bid continues to come back. That's the point where the reload really is, down at 46. So that's where your reload is. We'll put an RL there. You see there again, 230 trades into this 46. Market slows down, there's not much going on. There we go, 480 trades, and now we get an offer. So market's now offered. Trades into 45, and it does maintain an offer. Quickly back to the bid. So what you're looking for now is you're watching the way that this trades down. Can the sellers keep going? If this is to be a momentum move, remember what I said about momentum, you would need to see them sell into 45 and then sell into 44 and 43. But instead, all the time that they sell into 45, the bid keeps on coming back. And now we've got the bid back at 46. So what's happened is 44, there's been no trade into 44. So whilst you did get a lot of selling and you've traded 2,900 lots currently at 44, nobody has been able to actually get that to go offered and then get a sell, into 45. And nobody has been able to get that offered and get any significant sell into 44. 143 lots, very insignificant. And we continue to see this large order coming back. Now, if you want to join this, as we've seen, we've got 2 lots long now. If you're joining this is fine. You can join this iceberg. You can have a clear stop. Now, what I'd be looking for here in terms of managing your stop, you can see, again, trades 45, the bid comes back. I'd be looking at a stop somewhere down here, 43, 42. But if the absorption continues at 44, then I'm going to be aware that this may well continue at 44 and 43. So my stop is going to be dictated by seeing the absorption disappear as much as it is by putting a specific price. So now that you're long, what you're looking for, we've seen down here, there's a huge amount of trade got done. Doesn't matter how much gets sold into those 46s, they continue to reappear. These bids continue to come back. What you need to see now then for a bounce is you need to see people start buying into 47. Unless you see aggression and you get buyers into 47, this isn't going to bounce because all that the absorption is doing is slowing down the selling. But if selling continues, then eventually it is going to overwhelm that iceberg, complete that order, and the market can drop. If selling doesn't continue, then we have the opportunity for a bounce. So you're looking for the market to trade 47 and put a bid at 47 with very little trade back. You saw there 24 trades down, 140 trades down, the bid comes back. Even when you get an offer, it doesn't trade 46 now, the bid comes back. There you go, now it trades 48, bid straight up. This is a little moment of momentum. Trade 47, 48, 49. Nice and easy to trade that up. 49 gets a bid. There's very little counter trade now. It is all about large order trades up. Even if it trades back offered, it doesn't trade down. And that's the crucial bit. The fact that it doesn't trade down is your indication that people aren't now willing to sell. And so in terms of what exactly happens here, you have a situation where the market's come down, we trade 45, 46, 45, 46. And what you're looking for, the moment that this gives you the indication of the bounce for this little scalp trade, 46 to 50, is as soon as up here at 47, it trades 47 and it goes bid 47 very, very easily. Doesn't mess around, it doesn't hold back, it will go bang, trade through the offer, bid. And even though, yes, we did get a little bit of a sell, the sell was quite small, it was at 20 lots, things like that. And when the bid comes, when people start to buy, the buying is very comfortable. They buy 200s at a time, and then they buy into 48 and they buy 350. And straight away, the bid moves up and people buy 49. That's a great sign of action. That's a great sign that the strength is very, very much there. And that's what you're looking for. That was the moment where the absorption turns into a movement. Just spotting absorption is not the entirety of the story. That gives you the point to get in, but you need to be aware of where that little turn comes from that's going to give you that movement towards the upside. And that's what it was. Next up, we're going to add some context to this. This is now a situation where it's a less obvious absorption, but it's right where you want it to be. Go back to a profile perspective as well. So we're looking at Bund in this example. Bund is traded in a range. And within this, what you've done after a very, very tight range is traded lower, little block, and then traded higher. You look at the volume profile on the day at this point, all the action is centered here. This is an elastic band type movement back into value, and then you get the same story to the upside. So you have an elastic band you have a market that is willing to trade two directionally. So immediately this already says a market that is not likely to continue towards the upside. And you also are running right up to previous resistance at 36. This is a great place to sell. This is where you would want to sell anyway. And the fact that it's now looking like an elastic band, a stretch market, perfect. So now the case is, how do you get into this trade? And of course you could say, just sell it, just sell 36. But looking at the order flow, you then get a much better sense, not just of where to sell it, but also where you can then add on to this, where the turn comes. So if you just sell 36, technically what you're looking for is you're looking to sell 36 and you're looking for it to trade somewhere back down into this range. So you could say, right, well, I've got a short 36, target top of this little range, 20. So that's your trade, 36 down to 20. If you just sell 36, great. You sell that, you put a stop in somewhere, and you hope that it's going to come off. And the trade will work. But if you see the absorption, you can add to this position. You can build this position up. So you can build the position up. What we're looking for then is if you're trying to sell 36, you want to look at what's been going on. And we can see now already that there's a little chunk of size being traded around 36 and 37. Now, if you're trading this purely off the level, you're already short. If you're watching the order flow on this, potentially you were short anyway. But we've now just seen that we dropped down and we traded down to 32. Think back to that one that I just showed you where we traded 45, 46, 47 and then up. You've now seen the little drop down towards 32. So you can look at this now in two ways. We've held the level, we've also come down and we've held 32. So you've now got two options. This is where the order flow is giving you opportunities. The two ways that you can play this is you either play it by selling into the bid on the break of 32, or you do it by joining the offer at 36 and waiting for the trade into and through the bid at 32. So it's now just a little bit of a waiting game. And like I say, with these absorptions, it can take a little while for the trade to actually materialize and for the trade to work itself out. But all the time, you're taking on information. We just traded 33, comfortable bid 34, comfortable bid 35. It traded 100 lots at 34. It traded now 750 at 35. Watch what trades now at 36. We trade nearly 500 at 36 and the offer comes back. And now 600, 650. So total is now 1700 traded there at 36. Again, little snap, the offer comes back. And we see here now we trade 37. Gets a bid. What do you trade into 38? This is the point where this could go wrong and run towards the upside. We trade 54 into 38 just at that point. They sell again. Now you start once again to see the offers building up. People are becoming more confident to sell. 700 trades into 37 there. He goes bid. Does it trade up? No. 900's now traded and we're back on the offer. Trades 100 down. That's a larger order than anything else you've been seeing. The others have been smaller clips going through. Again, we trade 37, the offer comes back. Trade 37, the offer comes back. Now you can join the offer at 36, 37. The conviction comes from the fact that you already want to be selling here and now you're seeing that other people are doing the same. Other people want to sell. So now you're in a good place to be adding to your position. You also know the point where if this is to give you the move down, we need to get through 32. And you see there's a little bit of absorption there. We just traded 1,000 lots into 32. This is good. 1,400 into 32. We've now gone offer 31. This is great. This is what you want to see. Now we're trading down towards 30. This is exactly what you're after. So you want to see it staying below 32 now. You want to see it more selling into 31, into 30, into 29. This is what you're after on this trade now. If we start trading back to 32 and the market finds it comfortable to trade into 32 and get a bid here, you can reduce your position a bit. This is the scalping side of this type of trade. Again, you see a little bit of trade up, 200 lots, full trades down there. And we get an offer at 31. This is looking much better now. This is what you're after. And so this is all the case. We've built that position up here. Trade down 31. We're holding 32, so all good at this point. The only danger that you've got on this trade right here now is that we get a bid 32 and it starts to trade 33. That could be where short term we may be in a little bit of trouble. But on the whole, you're looking at this now. We're coming into this little bit of movement here. You're looking again for sell into 30, 29, 28, 27, bang, 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 all the way down. You can feel confident on this trade now. You've seen the absorption, you've seen the little range that was formed has been broken. Offers continue to come down. We've now got 1,300 trades. The absorption is now coming lower and lower and lower. People who want to sell now have to move their orders down to sell. And that's what you're seeing there. 1,300 just got traded and the offer stays. This is a sign of strength from sellers. This is now where you can have confidence of going all the way back towards 20. I will give you the details of this. When you've got your replay, you can trade this. Have a go at it. Have a go at trying to add on to your trade. Have a go at building your position up, sitting through that absorption. And by watching that and observing what happens, you then start to see how this sort of interaction takes place and how that feels when you're in a position. It's not about just saying, oh, well, I know it's going to hold 36, so I'm just going to sell it and let this go. It's about seeing how it trades there so you can build up this understanding and expectation of how the market trades in that area. Currently now, you just get that movement back towards 33. It does absorb it once more. Trades 33 again, and it traded 900 there, and the 33 holds, another 600 to 33 holds. You can actually use that as an opportunity once again to add on to your trade now to try and play this once more towards the downside. And looking for that next leg down. Trades 32, 32 gets an offer on it as well. This way you can add further onto the trade looking for the continuation towards the downside. So I'll give you the details of that and you can trade the entirety. This is a slower move. Slower moves will take time to play out as well, and that's an important thing to be aware of on a movement like this. But you see that absorption now continues at higher prices to allow for this next leg towards the downside. Okay, so what we've looked at so far is slower reversals. Slow market drops, holds, bounce. Now I want to go and have a look at a much more volatile one. Market with much more pace. And this way you're less looking at these precise price, like we looked at 36, 37, and you could see where it would trade thousands and thousands into a price. More now, you're looking at the volume profile building up. You're looking at the inability of a market to push through a small zone when it still has pace. And then you're looking for the change in that pace as it comes. So, the same example, this is the holding one. But what will happen is you're looking at this range to get created. And this is all because the absorption can't be done at one price. You can't buy, this is an example in gold, you can't buy 500 lots at one price by absorbing it. It's too obvious. So people will then split those orders up and they may keep on reloading 10, 10, 10 over 5 prices. It creates the same effect, but it's done over more prices, meaning that you get a range of prices. Here, you're going to see that that selling into the iceberg diminishes. The market will then fluctuate up and down. And once that diminishes, then you get the reversal away from it. Volume increases, so your volume profile will then build out, it will thicken up at the lows, and then that essentially pinpoints the little range for you. When you pop the top of the range, then the reversal starts to come in. And this is where you start getting these quicker moves up. People who partnered the iceberg can now feel confident of the run higher. They're coming in at this point. And also anybody who's been selling into lows has now seen a market drop, stall. They're already thinking maybe this won't keep going, and they add to the reversal as well. And this then quickens the pace as the market starts to bounce. So it's a similar type situation to the one that we just looked at. A market that begins to look a little bit stretched. We've traded well within the previous day's value for much of the day. And then you get a quick rip out of this area. This is it on a 1-minute chart. Nice fast drop. Now, of course, this could be a move that continues. And we've seen that from profile perspective of the idea that as long as it shifts value lower, the move can continue. But here, what you see is it very quickly stalls the action. This is a course of 5 minutes here, and we constantly bounce it on the same point. In doing that, it reduces the energy within the market. It slows the action down. And on top of that, if you look at delta as well, this helps show you what's really going on. What's happening then is people are absorbing it and then also buying away from this area. That creates this little pickup in pace, and that's then what allows then for the break towards the upside. So main area that you're looking for. The volume gets created down at 17.99. We form a small range, essentially 17.98 to 17.99.5. Oops. That's this little range here. And then you have the VPOC in the middle of the range, just there. So this is the area where the absorption takes place. I'll get the ladder up and we'll go and have a little look at what exactly happens. And this is the much more volatile absorption reversal. Okay, so we're just coming into the bottom of this drop. So we're just seeing this final part of the move coming in down here now in gold. Market's dropped down. You can see where there's a little pocket of volume as well at 1800. Now we trade down towards 98.6. At this point, no obvious reason to want to buy. You're still seeing generally pace on the book, pushing towards the downside, pushing towards the downside, pushing towards the downside. This is just giving you your first little bounce. I'll just recenter the ladder. So now what we're looking for, what happens down here? If you watch, each time you come up to around about 99.1, there's your little flick through to 99.5. But look there, you keep getting this absorption at 99.00. So this could be an opportunity to sell, and that's where people are going to try and sell. But what we're starting to see is a build up of two directional trade. Equally, you keep getting people buying. It keeps on flicking the orders back in every time you go down towards 98.3. The market then trades down, trades up to 00 or to 99.0, 99.2 and holds. These orders then start coming back as well. So you can now start to see where the market's fluctuating two directionally. Does trade 99.5, can't then pick up the pace towards the upside, and that's okay. So at this point in time, you're now starting to see that we're developing a small range, predominantly 98 to 99, but we are also able to trade 99.5. And there you go, you see it once again. 99, 99.1 holds, but we still keep on seeing every time it trades down there very quickly, 5s and 2s keep on flashing back on. So you can see now this little range being developed, and you can scalp that range. You notice it moves reasonably freely from 98.5 up to 99. That's quite a free, comfortable move. You get a larger order there at 99 as well. Once this breaks, bearing in mind, you do also have this kind of elastic band situation. You can expect on a break, this to quite comfortably move back up. And that's the bit that you're waiting for. Risk-wise here, keep seeing it trading down towards that 98.3, 98.4. You can scalp a little bit out of this anyway, but then what you're waiting for, this is the moment that you're looking for. You want to see the bids holding up here. This is a sign that buyers are no longer believing they can get filled down here and are now starting to increase their bids. 99 essentially becomes the point now where people are moving their bids up to. They start to hit into the offer more and more. Even when it comes back, buyers now bang, 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 straight up. Now you start to see a little bit of pace. You're up towards 00. Oops. You're up towards 01. Now we start to stall a little bit, and this provides you a reference point to start to cover a little bit of your position. But what this does for you is this is now illustrated where you see that shift of buying. And what you got is as soon as you got above 99, buyers realized that the market was not coming back down. And so therefore, they start to move their bids up. Meaning that in a very short term, what happens is as you drop down, we trade down here essentially to 99, maybe with a couple of spikes above. Once you get above 99, then we start to hold, and then you get the acceleration up towards 01, which comes on the break of 99.5 area. That gives you the quick flick up. Sorry, I've not drawn 01 very easily. There you go. There's your 99, there's your 99.5, and then quick move to 01 as all of the buyers give up in terms of waiting to get filled and instead become active, drive the market higher. That's what you get in this situation. So a much more volatile absorption reversal there. Market holds across a range of prices, giving you the opportunity short term to scalp that range, but also then giving you very clear reference points where the break's going to come from. Don't get me wrong, it could break down. If the absorption down at 98.3 gets overwhelmed, it will keep going. But you saw how quickly that kept on coming back, coming back, coming back. And the structure of the day also supports that idea. Next up, what we're going to look at is the flip of this, of the absorption essentially holding the market, pinning it on the low, ready for the break. So what we're looking at is not the absorption here creating the bounce, but instead, once the bounce happens, the absorption comes in and holds the market, prevents it getting off the level. And essentially, somebody's taking advantage of people seeing this level as an opportunity to buy. They buy away from the level, and someone then absorbs all of that buying. They sell and they sell and they sell to them. And in doing that, they trap the market. Now, everyone who's bought here is in trouble. And as the seller then starts to push on the market, this then accelerates the move. And they can actually then follow this and follow the absorption down. So that's what we're going to go and have a look at. This is an example in the euro. We're going to look at the way that the market absorbs the buying action and then drives it down. Let's go and have a look at this example in the euro then. What we're going to see here, as I talked through, is the idea that once we've hit the low, we're going to bounce off the low, and this is where you're looking for that absorption to come in, to basically pin the market on the low, ready for the breakout. Where the trade's going on is this small break of range. Now, This is a move continuing this large move down on the hourly. So at this point of entry, we're trading somewhere around about here with a target back down towards the breakout point from the previous day at around about 15.22. It's not a gigantic move, but it's an opportunity to take a reasonably clean trade with relatively small risk. The iceberg defines the risk for you. You know where the breakout point comes because you've got a small range established just here with a low of the range at around about 37, as you can see on the day here. So you're waiting. Once the iceberg comes in, this then gives you the chance to execute. Without this, the move down to the low of range could be just like this low and this low and this low. And this is where you're differentiating. The absorption says now is the time to go for it, provides pressure, and then you get the break. And you actually then see a continuation of this absorption. Whoever's trying to sell gets some of their business done and still needs to do more. And in doing more, they then chase the market down and pressure it onwards further. So let's go and have a little look. Right, so here we are approaching the bottom of the range. And at this point, on the face of it, not a great deal to be noticed here. But what you're starting to look out for, watch 37, look at the absorption. We traded 45, 50. That was the previous low. We've now done 97 lots. This is where you can have a go at selling it. You know where the stop can be. As long as you're not trading back above 37, 38, this is where that little tick down comes from, you're okay. And again, watch the 37. Trades there, we've now done another 12 lots. So it's not huge, but it's the persistence. Any trade that comes up, that offer comes back, trades through it, little flick up. And yeah, with any trade like this, you have to accept, as we talked about with the previous absorptions, that the market may flick up slightly, but you saw when it traded 37.5, absorption comes back. So now we're quite clear where our stop is. You can place your stop at around about 38, 39, just so that you don't get caught out by any kind of small flick back up. But now we start to see the drop. And watch again, watch the amount of trade that comes in down here. As the market starts to drop down, it's not allowed to bounce. Any attempt to buy is just met by more and more selling. You still keep on seeing that last traded quantity going up, 178, 250 lots, all done at 34.5. So the market's getting pinned down even after the break. There's no attempt to bounce, or any attempt to bounce is very quickly absorbed. And this continues to maintain this pressure. Think what you'd be doing if you were long now. You're realizing the market's just being driven against you. It's not able to bounce. This creates panic. People now start to look at this and think, we need to get out. Again, trades down to 31, stalls, and the pressure comes straight back in. And then you get this final drive down. Once you have that, a little bit of a shift. If you're looking at this as an opportunity to take a short-term trade, then this is your chance to get out. You got the absorption at 38, at 34.5, at 31, and the market now whips down. And you're still seeing absorption coming in at 27 as well. So as you're seeing this, you've got two ways of approaching this now. You can, just to pause it there, you can look at this, and as soon as it puts in that quick drop, you can take your trade. You can take your trade off there. That's your opportunity. Bank your profit, because at that point, the pressure has changed from pushing on a market to now just driving it straight down. People have panicked. They've created this quick rush. That's the end of the move. Yes, it hasn't reached the target, but this is a price action, order flow based exit. Alternatively, you can use this next stage of the absorption that's followed down to lower prices at 27 as your stop. And then any movement above 27 is a chance to exit trade. Either way is a viable option. You know, it's your choice dependent upon what you're trying to do. In this situation, the fact that the target is down around about 22.5 anyway, and you've got these couple of lows here, which come in at around about 28, then you could be looking at this with the view that that's quite a reasonable move. And so therefore you don't need to continue to add on. If, however, you are looking for the continued move all the way through the range, then there's some value in saying, right, well, seeing it back above 27 is acceptable, as long as we're not getting back above 31, which is where that drive down came from. As long as we're not getting back above there, then this move is still okay for the larger move. So if we go and look at the continuation of this for a little bit. Anyone playing the short-term move, you start seeing the absorption continues at 27. Now it trades 27.5. The bids are coming in a little bit easier. And again, you can be out. You can take your trade off. You've banked yourself 10 ticks. Alternatively, as it does start to bounce back up, you could look at this with a stop around 32, above that previous absorption, use that as your stop to then try and play for the next leg of the move, to try and play for the larger move towards the downside. So it's all about thinking how do you go about taking these trades on? What's your plan when you're in the trade? The absorption allows you to identify the timing of the break, which you get here. It enables you to follow the move onwards, potentially add on, particularly when you've got the further absorption at 34.5. particularly again when you got the next area of absorption at 31. And at that point, there was a clear sort of two-way battle, but buyers could not drive the market up. That's the big sort of factor here. Buyers consistently couldn't push on any further towards the upside. They come in, offers come back and back and back. And as that happens, this gives you confidence to the downside. If you see the same come in again, same play. You can take the same trade on. Use those offers coming in as your opportunity to sell more at 30, 31 area to try and play once again for the low. This becomes a wider range then, and an area that the market can trade within, as opposed to just simply being, as we saw here, a sort of stepped move down. You can then start to trade between 31 and 25. Note here, the activity's died off. The speed of the market has gone down. And in seeing that, this is also a good indication that we are going to have to wait now. Whichever thing is going to happen, whether this is a reversal from here, the absorption and then reversal as we saw with the gold example, or whether this is to be a continuation, is now a matter of time. And anything trading within this range from 31 down to 24 is opportunity then to sort of continue to build position. And that's the way people are going to treat that type of action. That's what's happening there. You've seen this sort of two-directional rotation now. And this can be an opportunity to scalp. You can use this range as a chance to scalp, selling 31, exiting around about 24 each time. So there you have it. That's the absorption to create the break. It gives you that pressure, and that pressure coming in is what says now's the time. It allows you then to play this move. And technically, this trade looks good. Yeah, it's a decent area to break away from. It's a decent opportunity. But without that absorption giving you the indication that now's the time to do it, it's a very hard trade to take to time that accurately. We'll move on now. And looking then at iceberg failure strategies. So far we've used an iceberg to partner. Join your iceberg and allow the action that is taking place, the person wanting to sell or wanting to buy, to prevent the market going against them. They hold the market, and then over time, the market will then release in the other direction because it cannot generate sufficient energy to drive through the iceberg. Now we're going to go and look at a market that has a different scenario. What we're looking at on this one then is a break of an iceberg. Now typically, this is usually a very fast iceberg, and more commonly in an environment where a market is moving quite quickly. And what will happen is someone will use that liquidity, that speed of market to get some business done. And the first example I'll give you is exactly this, a very, very fast automatic iceberg. So each time the price trades, once the offer, in this case, falls below a certain number, it will be increased again, and the same again. That's quite typical for an iceberg that may break. Now, that's not alone an indication that it's going to break. The speed of market is your main indication. So what you're looking for then is a quick market. As long as the pace is maintained, yes, the iceberg creates a barrier, but as long as the orders continue to go through at the same speed, eventually that barrier is going to get broken. And that's what you're watching out for. So you want to see it hit the iceberg and no let up. No kind of hesitation, slowing down in orders being put through. The orders keep on coming fast, 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 fast. Once you get that, that's where you can start thinking, yes, now we can try and play through the iceberg. What is going to happen is positions are going to get trapped. People will approach an iceberg in a consistent way. And for some people, every time they see one, they will join it, not taking account of the pace with which the market's trading. This is where a footprint can sometimes let you down because you don't see the pace of the orders coming through. It just shows where the iceberg is. We'll look at icebergs on a footprint as we get to that stage. What you're looking for then, in order to break the iceberg, is you want pressure to build. So you want the market to become increasingly pinned on the iceberg, like that one we just looked at in the euro, where as the market comes off, the pressure comes from the iceberg pushing down on the level. In this case, you want the market to not be able to escape, not be able to bounce away from the iceberg. And in doing that, it creates this continued pressure. That can be an opportunity, in fact, to actually get into your trade, to join early before the break actually comes. Other things that can help you is correlated markets. If you've got another market moving at the same time, and you'd expect the market that you're trading to be moving in a similar direction, in a similar way, the iceberg essentially is just acting as a short-term barrier. Once it's out of the way, you can then catch up to the main market or the other market that you're correlating to. So look for other markets to add conviction to your trades. Different opportunities to enter. You can get into this trade simply by hitting into the iceberg. Now, of course, By doing this, you're doing the opposite of joining the iceberg. You're playing on the assumed probability that the iceberg is going to break. It does open you up to a risk that is very difficult to quantify. I'll give you an example of this in just a moment. It opens you to an unquantifiable risk, but what it does do for you is ensures that you're in. You have a lot of liquidity to hit into there, and that's a useful thing. The alternative way of doing it is as you bounce away from the iceberg, and as those bounces get smaller, you start to look at the rotation away. And in each rotation away, that can then be the place where you place your stop. So you place your stop above those rotations. And in doing that, you give yourself the opportunity to define your risk. And your risk should theoretically get tighter and tighter and tighter as the pressure continues, as that velocity continues. And it's the order flow that matters. If the speed slows down into the iceberg, then you've got to look at that and see that as an indication that the iceberg is unlikely to break. In terms of your expectations on the trade, you are expecting a quick push through. That's the first thing. Now, after that, it comes down more to your context, more to your understanding of why you're taking this trade on. And this is what you have to think about before you enter. Are you taking the trade to play a break of the iceberg, take advantage of the quick zip through and the iceberg's partners being forced out? Or is this an opportunity to get onto a larger directional trade? In which case, your exit is going to remain back above the iceberg. So it's all about going into this with a clear plan as to what is the iceberg enabling you to do. As a trade on its own, the simple trade is you play through it, drop, get out. You're taking advantage of the people getting trapped. If you're using this as a way of accurately executing a more directional, longer term play, then it is simply a trade where you get in, your stop goes back above the iceberg or back below the iceberg, wherever the iceberg is, on the basis that if the move is to continue, you will see continued progression in that direction. So let's go and have a little look at a more sort of explained example. What we're going to see here, this is one in the French Haute. So not a common market to show it in, but it's a great example of what I call an automatic iceberg. This is a very fast market. This is right on an open after significant news. So you've got a quick market and somebody takes advantage of this. They need to get some business done. Now you'll see in a moment how thin the Haute can be. So with a market being so thin, to try and sell 300, 400, 500 contracts is going to be very, very difficult. But by iceberging, selling into the strong, fast move up, somebody will be able to get a significant amount of business done. So what we're looking for then is you get this very, very fast move to a large order. And no hesitation. Market hits into it, hits into it, hits into it. It does back off slightly, and being in a very volatile situation, the flicks down can be quite large. This is what you're watching out for. You're trying to use those flicks back as a way of trying to manage your risk, trying to decide where exactly your stop is if you hit into the iceberg. As long as the market doesn't slow down, you can be confident this is going to work. You can be confident then that the iceberg is going to break. Now, once it is filled, and what you're watching for here is as the iceberg gets hit and hit and hit, all of a sudden you'll see that it gets smaller. It doesn't come back. And when it doesn't come back, there's your opportunity to hit more into it. That's the point where you expect the acceleration through the iceberg and your opportunity then to take profit. In a situation like this with an extremely volatile market, you're looking for a jump and then some indication from order flow to say that this is perhaps the end of the trade, the chance to get out of the trade. So let's go and have a little look at this. So here we go. Look at the Haute. What we're going to see here, very, very quick move up. So very, very low liquidity. As I say, this is right on the open. We moved from 07, we're jumping up. Nothing obvious here, very, very thin. You see a lack of orders. Now, here's your first little hint that there is some action. And what you want to be looking for, watch this last traded quantity, roughly whereabouts that's ticking to. We keep seeing it trading down towards sort of 35s, and I'll try and write the numbers down on here. So 35 is an area that we're coming down to quite a bit. So that gives you your first sense as to where you are. Now, starting to tick up, liquidity comes back a little bit more now. So this is good. You've got a little bit more conviction or confidence in any movement that you might see. Now, everyone can see the obvious large order. There we go, up at 53. We've got around about 300 contracts, give or take. And you've also got a large order following us up here, 169. Now watch what happens when you trade into the 53. Trades it down to 200, just below 100. Market starts to tick back. This is where you're watching. Where do we come back to? Down to around about 47. And immediately we're back up towards 350. So you're now starting to create a range, 53 to 47. straight away back to 300. Now the amount drops down. That was very, very quick to see, and we'll replay this one for you as well. And we then start to rush up and we get another 200 at the high. So this is now taking us all the way back up towards 90. That's your opportunity to get out. This is a very quick opportunistic trade. You hit through the large order, jumps up to 90, you another large order. Think about what people are going to do ahead of that. If you've just got long on an opportunistic trade, you're going to see that as an opportunity. Take your profit. You've just banked yourself 40 ticks approximately on that trade. Quick profit take, trade is done. Nice and simple opportunity, and it's very much a kind of scalp opportunity here. But the main bit of the trade to be focusing on then is as we move up, we see the liquidity start to come back in when we're around about 35. We then trade up towards 53, and once you hit that 300 to start with, first thing that you want to be thinking about is, can it break or is this going to hold? Now, in order to make this decision, you need to see where the pullback goes to. And that comes back to around about 47. You can't be super accurate on this, but you can look at this and say around about 47 seems to be about the limit of the pullback here. As such, you've now got a chance of playing a stop down at around about 45. Doesn't mean you have to get long, but it means you've now got options. And you're making these decisions very, very quickly. As you saw, this is a very, very fast move, but you're making this decision quickly. You've got to stop roughly at around 45. You know what your options are now. You can buy it into the large order, which you see then icebergs. It had 350, it went down to 200. As the market came off, it went back to 350, went down again to 200, and then dropped. So that's fine. You can buy it into the large order. You can buy it on another pullback, which once again holds, or you can wait for this iceberg seemingly to be defeated. And as you come up the next time, it drops, it gets filled, but once you get down to 200, the automatic iceberg doesn't jump the number back up. Instead, it continues to trade down below 100. This is now your chance to buy. So you can use that as your opportunity to buy. Once that number drops down, the way you've got to think about it is, as that number drops down, there's less and less to hit. So if you want to get in, you're going to have to be quicker to get involved in this now because there's less opportunity to hit. And if the iceberg isn't coming back, because it's not followed that very, very brief pattern, then you need to get in right now. You need to take that opportunity quickly. If we go back and watch this from the start, you'll see what I mean. Complete lack of liquidity here. It's not clear what's going on. You see the large order at 53. Market backs off very quickly, back down towards the mid-30s. And again, keeps on trading the mid to low 30s here. So that's giving you your first bit of clarity, but really you want the liquidity to start to come back in. That takes a little bit of time. Now you see a little bit more steadiness. The bid-offer spread is now getting that little bit smaller as well. And the market's now starting to stabilize. So we're all good at this point. And you're watching now what's going to happen next. The 300 lot, very, very obvious. We now have a 200 that chases up as well. So as we trade into 53, that order gets depleted. And look where we pull back to. There's very limited pullback now from that 53 area. And another large order comes in. So there's clearly a willingness to buy. Now it reloads once more. Now it's gone down and you can hit it. And it's about hitting that as soon as that order reduces. As soon as that happens, you jump in. You're looking for this quick rush up. And as the market rushes, you get another large order at the high, that 200. As soon as you hit that, there's your opportunity to exit the trade. You take that quick exit, job is done. You're making the most of the high volatility of a market that is happy to maintain the velocity, to keep on hitting into a large order, which actually returns again at 54. People show some hesitation, it gets filled, then you get this fast jump around. Once you've reached this phase where it's very unclear as to which way the market wants to go, this is a time to kind of step back. Step back and say, right, it has become unclear. I don't need to go rushing into anything. Particularly if you've taken advantage of that. You've made your 40 ticks. You can now wait for liquidity to come back, a little bit more clarity to come into the market so that you can then start to make a decision from that point. At this point, very, very unclear still. Market's still sort of jumping around, no clarity, and so therefore you don't want to be involved in that. It's taking advantage of those little moments that highlight an opportunity. And when you see that, that's where you can get involved. Take that chance, make the most of the opportunity and move on. And that's the way you want to try and approach these opportunities. Other scenarios, which we'll go and have a look at just now, will provide you with more. They'll provide you with the opportunity then to play a larger move, a much more directional move. So, quick explanation of what this trade is before we get the ladder up and can actually have a look. What we're looking for then, this is an oil example. We're looking now for a breakout through the highs of this range. We've got a 3-day range established here. You're looking for a breakout at the high. So you've got a high coming in here, 72.60. You've then got number of highs all coming around here. So you can expect, as one would with any kind of range, that once you reach the extremes, there are likely to be stops. So therefore, this is not just a trade where you're trying to play against an iceberg. This is a trade where you're actually looking at this as an opportunity to play for a more directional move over a longer period of time. The iceberg merely gives you the opportunity to get in early. And so what we're going to see then is this move up through 46, which on its own, reasonably innocuous level, but you can see where the reference has come from over here. But when you get the iceberg here, this now gives you an opportunity. And as long as the market pressures this, continues to maintain that velocity and hit into it, this is now a chance to be in from the mid 40s, with the expectation that if you can reach 60, this will break. And if you break 60, you're then looking up towards 75, 80. And so now you're on a trade where by breaking the iceberg, that provides you your entry. And by breaking that, you could be on at least a 35 tick winner and the potential really to be on a much larger, more directional move. So it's using that to get yourself into a wider trade. They don't all have to be short-term opportunities making the most of the iceberg being defeated. In this scenario, this becomes your access, becomes your opportunity to get in the trade. So let's go and have a little look at this one. So here we go then. Let's go and look at this on a ladder. So right at this point in time, we're trading up to 47. And you can see immediately that there's already 346 contracts traded at 47. And that's fine, that doesn't really tell you a great deal. But it's what then happens after that. If you're looking at this as a trade opportunity, yes, you do have the high of the day around 47 at this point in time, but you know realistically your chance is to get in before we reach 60. Now, the more that goes on here, the more information you're getting in terms of opportunities to trade. Watch what happens at 47. We've now traded 828 lots, 477 at the price below. So somebody is clearly trying to sell here. They're trying to hold the market, get their business done. Now, what their objective is, you don't know. They may be getting out, they may be getting in. They may be using the liquidity, people coming in to buy, as their chance to sell. You don't know, and we don't need to know. What we need to know is whether the market maintains enough pressure, enough velocity to hit through this large order, hit through this iceberg. So, back up. Again, you're looking to try and work out where your entry point is, how you can take this trade on. So there we go, we trade through 47 and it maintains a bid. That's good news, but very quickly offered 200 more trades. So this is clearly the point where people are very, very willing to sell, but notice the market does not back off. Buyers are still quite happy to come in the price below and actually now start to counter absorb. They're not letting the market drop. And so you now got this sort of two-way battle. And there you go, you sort of sell into 46, 78 lots, the bid comes straight back and continuing selling at 47. Now 1,200 traded at that price. And continually, every time it trades 47, it just constantly reloads that offer. So you know exactly where you want to be in now. There we go, 1,300 traded. And the 47 still cannot get a bid through it. It cannot allow, or it will not allow the market to go higher. So the way that you might want to try and approach this, having seen this now, is to work out, right, how far back are we falling? Where could I place a stop? We're barely falling below 45, so you can actually start to attempt to buy from down here, 44, 45, 46. Perhaps with a stop slightly below, around about 42. But there's no real need to rush in to execute this trade. Equally, you've got a couple of larger orders above here as well. Now you can use those as your opportunity to enter into. Think about what's going on here. There's a lot of people who are probably joining that iceberg. The person selling there is not alone in this. And the fact that it keeps getting eaten up, allows the market to go bid and then sells back to it, is an indication that they are willing to let the market go up. Buyers at this point are not willing to keep driving the move. So you can keep on watching. And this is often the case with an iceberg. It's about biding your time, working out where you can get in. As I say, if you put your bids down 46, 45, 44, you could build a position here, meaning that when it breaks, if it does, you're already on side. You're not having to deal with trying to chase this as it goes. Your other option is if we get a bid at 48, which so far it has struggled to do, then as long as it very quickly trades into 49, 50, yes, there's some larger orders there, but you can hit into those, use that liquidity to hit into, get your trade on before the larger move. You see, again, now we trade 48, but straight away, 250 trades at 48, offered again. So the iceberg's not done. It's happy now, clearly, to sell at 48 and at 47, but inroads are being made. We now traded 47 and got a bid. And the bid is now beginning to look like it's holding. Trades back and the bid comes back. Now you can be confident. Now you can start trying to buy 51, 50. This is your chance to get in. You know where your stop is now. It's clearly defined below the iceberg. So you can be getting long at 51, stop around about 45 now, and waiting for this move. Remember, your objective here is to get above 60. If you get above 60, this is where one would expect the market to accelerate towards the upside. So yes, it looks uncomfortable, and yes, there is clearly still a willingness of sellers here. But that's fine. The sellers are being defeated. Now we get the jump nice and quick. We popped up, we get 300 come on the bid, and now the market jumps. That's what you're looking for. That's what you're waiting for on this trade. And you now start to see the large orders actually chasing higher. That's what you're after on a trade like this, that when the market gets pressured into those large orders, it will not pull away. And by doing that, it gives you the chance to enter. It also gives you the conviction that this is going to work. Now, of course, the iceberg could be big enough that it prevents the market from going any higher. It constantly absorbs and absorbs and absorbs. And you go through this cycle where the longer a market spends being absorbed without that break, the more and more people get long in this situation, and they're more and more nervous. They're waiting to get paid. Now, in order to get paid, they need new buyers to come in and continue to attempt to break this iceberg. Over time, you're going to run out of new buyers. And the problem then lies in that everybody who is long now is not necessarily trapped, but they're becoming nervous. And as they become more nervous, there is a risk then that the market starts to tip, and it only takes a small tip back, in this instance, perhaps below 45, and you can see quite a quick exit. So there is always that risk. But as long as buyers continue to drive into this, and as we saw there, the bids were actually beginning to be reloaded at 46 and 47, showing strength, showing a willingness to still buy at higher prices. When you're getting that, you can have conviction. Think about what you're playing for as well. This gave you a situation where your stop could be around about 45. Perhaps 44, 42 if you wanted to make sure that you weren't going to get trapped on the trade. So you can give yourself maybe 5-6 tick stop on this trade. But remember what you're trying to play for. Just to get to the breakout point, you're going to be 15 ticks on side. Once that break comes, you're expecting another 15 to 20 ticks to get to this high. So that's 30 in total. And then you can look for continuation. So that absorption is giving you the opportunity to build a position with a very small risk. This is the chance then to really kind of what you call load the boat on this trade. You know, you're taking 5 ticks of risk for a potentially 30, 40, 50 tick winner. This is your chance to take the risk on, and the absorption provides you the precise point to do it. Without that, this is still a good trade. If you see pressure coming in, market picking up pace into the high, this is still a great trade to buy 46, 47, 48. But it doesn't give you that clear point where you can leverage your position up by hitting into the iceberg, and then also buying through once you started to see the bid holding 47, holding 48, and then pinging up towards 51. That's the point where now you can leverage the trade up. The iceberg's being defeated, and now the only issue that you may have is if you don't find any new buyers beyond there, if the sellers who have joined the iceberg don't rapidly start buying, that's the only real reason why the market could then rotate back down. But apart from that, you're in a great position then for this continuation move to play for 60, 80 towards the upside. So that's how you're using an iceberg to try and play a breakout. It pinpoints your entry, it allows you to leverage your position up. We're going to have another look at a similar version of this, one in the S&P. So an S&P breakdown absorption break. So technically, what we're looking at then is a market breakdown at the beginning of the cash session. Now, we've looked at these types of trades in profile. It's a caught in the hole trade. So we have previous day's cash session, very, very stretched, closed very high up, value left much lower. So you've got around about 35 handles of space between top of value and the close. Overnight session, very balanced, muted session. That's great. For a caught in the hole trade, this is ideal because it provides you a clear area to play the break from, 53.25, and a very clear target down at 30. So 23 handle target. Now, we're going to look at what do you do if you've not been able to get into this trade? If you missed the break of the overnight low, or if you've hesitated as it started to bounce back up. So we're going to go and have a little look at this move as the market drops down and creates a very, very obvious volume edge at 44.75. How does that get created? An iceberg. And so as this iceberg shows its face, we can now look at how do you go about playing this trade? How do you realistically approach this? Because technically, this is quite difficult and quite potentially costly. The technical, easy way of looking at this from a risk management perspective is to say, okay, I can sell into the iceberg at 44 3/4, and I can put my stop above 53 1/4. So you're going to take around about 11 handles of risk. But your payoff on this trade is relatively small now. Your payoff, your reward on the trade, is now in this situation